Today property is stolen through pen and electronic means as evidenced by various financial scams during 2008 crisis. The financial crisis of 2008 or Great Recession is considered the worst economic crisis since the Great Depression. Now over a decade later, are we heading again towards Great Depression? There are several signals which indicate that we could be on the verge of an economic meltdown. Financial crises in general are pretty similar, for example dot-com bubble and 2008 economic crisis. The next global crisis might take place in a similar way. We have multiple bubbles that are quite big and might burst anytime in the future, such as student loans, U.S. corporate debt and derivatives market. What is a yield curve? Yield curve is a graph charting the rates on treasury bonds. Slope of the yield curve gives an idea of future interest rate changes and economic activity. There are three main types of yield curve shapes: normal, upward sloping, inverted, downward sloping, and flat. The curve normally steepens in a growing economy because investors demand higher yields on longer-dated bonds in case inflation rises. An inverted yield curve reflects a scenario in which short-term debt instruments have higher yields than long-term instruments. Typically, long-term bonds have higher yields than short-term bonds. An inverted yield curve is often seen as an indicator of an impending recession. Should we be worried about the yield curve? Yes, because it inverted for the first time since the 2007 financial crisis, warning that investors expect an economic slowdown. It shows that the U.S. is headed towards a recession in 2020. That's the message from a widely monitored bond market yield curve. Fed officials from Alan Greenspan to Jay Powell watch it closely. But why is it so important? Going by historical data, the significance of an inverted yield curve in predicting recession cannot be ruled out. In March 2019, inversion of the yield curve hit 3-month T-bills for the first time in about 12 years when the yield on 10-year notes dropped below those for 3-month securities. That metric reverted and then inverted again in May and is now trading at negative 36 basis points. Counter-argument is a recession may still be a year away. And not everyone agrees it to happen. But bond market gyrations are already threatening to bring down stocks globally. Stock markets are going up, venture capital may also be overvalued, and firms are highly leveraged. But, if one asset class stands out for its high prices and potential systemic risk, it's supposedly low-risk bonds issued by governments in the US and Europe. Since many investors are mostly concerned with preserving capital, risk-free assets, like treasury bills, are safe options, which offer a certain return over a short amount of time, and are easy to buy and sell. Demand for safe assets is global, however, only a few big stable countries like US, Germany, and Japan are producing these safe assets, which means that the demand for safe assets outstrips the supply, making these supposedly risk-free assets risky, because the prices of these assets are increasing their fundamental value. Normally, prices would adjust accordingly, with yields falling and prices rising until they reach an equilibrium. But, there is probably a limit to how high risk-free asset prices can rise, or, put another way, how low or negative interest rates can fall, creating a bubble. A risk-free bond bubble may pose more systemic risk to the economy than a standard asset bubble. The risk-free interest rate is the foundation for everything. If this bubble bursts, the whole economy would collapse. Supposedly risk-free assets are looking awfully risky. There are bond speculators who are betting prices will keep going up, a classic factor in a financial bubble. But, to some extent, high bond prices are also driven by risk aversion. But, economists normally consider risk aversion a preference, and it is hard to argue that people's preferences are wrong.
Bill Gates, the world's richest man, has a fortune of 65 billion euros. That's the market value of his shares. To compare, the total value of all of the world's cash is less than 100 times that amount, 5 trillion euros. The value of all goods and services created every year around the world is 75 trillion euros. That's the real economy. The world's debts are far higher than that. States, businesses and private individuals all have debts. A world living on credit. 705 trillion, that's the value of all derivatives, the speculative financial bets on the future. They've got almost nothing to do with real goods anymore. To recap, this is the fortune of Bill Gates.
According to the final report of the National Commission on the Causes of the Financial and Economic Crisis, the losses were magnified by derivatives such as synthetic securities. Where are we today? The derivatives market is, in a word, gigantic, often estimated at more than $1.2 quadrillion on the high end. Some market analysts even place the size of the market at more than 10 times that of the total world gross domestic product, GDP. This approach had opened gaps in oversight of critical areas with trillions of dollars at risk, such as the shadow banking system and over-the-counter derivatives markets. The growth in globalization, derivatives and leverage over the past 40 years have made financial panic and contagion all but impossible to contain. Many banks have shifted their swaps overseas to avoid U.S. regulation. Although all G20 countries agreed to regulate swaps, not much has been done. This entire financial system that revolves around greed is eventually doomed to fail. The proper application of Islamic banking system will help reduce the effects of the global economic crisis at any given moment, for its outstanding ability to rectify disorders resulting from the application of contemporary capitalism. Allah says in the Quran, Allah destroys interest and gives increase for charities. In the financial crisis 2008, $11 trillion in household wealth was destroyed, with retirement accounts and life savings destroyed. With regard to loans for consumption purposes, in times of need, ethical considerations demand that people should help each other without charging interest, because to charge interest amounts to taking advantage of a person's weaker economic position, which is against the Islamic spirit of justice and equity. Great responsibility lies on Islamic banking to prove its ability to provide Islamic alternatives to face the repercussions of the financial crisis, focusing on financial instruments and Islamic products, whether in attracting or investing capital.